The news are constantly talking about the debt crisis in America, trillions of dollars, rising interest payments, and a government that borrows more every year. Yes, that is concerning. But what if all the attention is pointed in the wrong direction? What if the real threat to the global economy is hiding behind official statistics, buried beneath layers of quiet approvals and state control? There is one economy that has long been seen as a model of discipline, strategic planning, and financial stability. But beneath that facade, something does not add up. The numbers are blurry, the motivations are strange, and the truth is, no one really knows how deep the hole goes. This is not just a matter of accounting or budget policy. It is a growing imbalance that could shake the foundations of the entire global system. Because if you follow the money, you will find more than just debt, you will find intent. So let's break it down. America's debt problem has become too serious to ignore. In the year 2025, the United States federal debt officially passed $37 trillion, and interest payments alone are expected to exceed $1 trillion per year. That is more than the country spends on defense. And this is not about one-time crisis measures. The gap between government income and spending has become permanent. Every year, the U.S. collects about $5 trillion in revenue, but spends more than $6.5 trillion. This deficit is covered by new borrowing, and that borrowing keeps getting more expensive. The United States has one big advantage. The dollar remains the world's reserve currency. This gives America extraordinary freedom. Global demand for U.S. Treasury bonds continues to feed Washington with money, even when the economy does not appear strong. But that does not mean the debt is safe. The more the government borrows, the more pressure there is on interest rates and inflation. And the higher the rates, the more expensive it becomes to service the debt. That creates a vicious cycle that is hard to escape. All of this is easy to track. Every bond issuance, every deficit report, it is all public. Investors know what they are dealing with, even if they do not like the numbers. But the scale is still shocking. By many measures, the United States is the most indebted entity in human history, surpassing war economies and entire regions. And if nothing changes, the debt is projected to reach 138% of GDP within the next decade. But at least we can see all of it. It is all in the reports, and that is rare. Because on the other side of the Pacific, there is an economy where things work very differently, and where the true scale of debt is buried much deeper. On paper, the Chinese economy appears strict and disciplined. Officially, China's government debt stands at about 88% of GDP, noticeably lower than in the United States or Japan. But those numbers are just the tip of the iceberg, because the borrowing system in China is far more complex and much less transparent than most people realize. Unlike in the United States, where all borrowing is concentrated at the federal level and can be easily tracked, China's debt is spread across a vast network of regional authorities, opaque financial platforms, and a sprawling system of state-owned enterprises. At the center of this system are provincial governments, which actively raise funds to finance infrastructure, construction, and social projects. But they are not allowed to borrow directly, so they create so-called local government financing vehicles, entities that are not reflected in the national budget, but still issue bonds and take out loans. As of the end of the year 2023, these platforms held over $12 trillion in debt obligations, and a significant portion of that is considered risky. Now add to that 391,000 fully state-owned enterprises, operating across sectors from construction to banking. These companies blur the line between the public and private sectors. They actively take out loans, often under implicit government guarantees, yet their debts are not reflected anywhere as public debt. According to Stanford University estimates, the total debt of these enterprises exceeds $30 trillion, a staggering figure. When you combine the debt of the central government, regional obligations, and the liabilities of state-owned corporations, China's actual debt burden is rising rapidly. By some estimates, it already exceeds 300% of gross domestic product. And considering that the accuracy of Chinese statistics is often questioned, the real numbers could be even higher. This is not one big ticking time bomb, but rather an entire web of debt, stretched across departments and hidden from the public eye. And yet, despite such enormous levels, China does not stop borrowing. On the contrary, this system continues to function thanks to another, far more powerful tool: control. So how does China manage to borrow on such a massive scale without triggering panic on global markets? The answer lies in its tight control over capital flows, both domestic and international. Unlike most countries, China enforces strict currency controls. Money cannot flow freely across its borders. Investors, companies, and banks cannot simply move capital abroad or invest in foreign assets. As a result, vast amounts of money accumulate within the country, especially in state-owned banks. And those banks have virtually no other choice but to invest in bonds, instruments issued by the government or its affiliated entities. But that is not all. In other countries, when government bond yields fall, investors shift to stocks or real estate. But China's stock market has not kept up with its economic growth. Since the year 2000, the Shanghai Composite Index has grown by less than 100%, while the American S&P 500 has increased by more than 300%. Many companies traded in China are still heavily tied to the state and are not attractive to profit-oriented investors. And the private sector does not guarantee stability either. Remember how, in the years 2021 to 2022, the authorities abruptly cracked down on giants like Alibaba and education platforms. When stocks offer weak returns and capital is locked inside the system, the bond market remains one of the few large-scale avenues for investment. And since inflation in China remains unusually low, even a modest yield, like 1.7% on 10-year government bonds, looks attractive in real terms. Behind the scenes, the government actively uses state-owned banks for quiet monetary expansion. From the year 2000 to 2024, China's M2 money supply increased more than 17-fold, compared to just a 3-fold increase in the United States. This hidden credit injection has maintained liquidity in the system without causing a typical spike in consumer prices. But inflation does not disappear. It simply changes form. And in China, that pressure shows up not in stores, but in a very different area. For millions of Chinese families, real estate has become the only reliable way to preserve and grow savings. Access to foreign assets is restricted, the stock market is weak, and currency controls are tight. So people have poured money into apartments. By the year 2024, more than 70% of household private capital in China was concentrated in real estate. Buying property stopped being just about having a roof over your head. It became a survival strategy. But this investment frenzy has created something enormous. By some estimates, China's real estate market is the largest in the world. Its total value exceeds $60 trillion, more than the entire US housing market. In cities like Beijing and Shanghai, the average price of an apartment exceeds 35 annual salaries. For comparison, in Los Angeles, it's around 7.5, and 13 in Sydney. The problem is that housing prices kept rising while incomes did not. More and more money goes toward mortgages and savings, while spending on consumption continues to fall. Today, personal consumption accounts for only 38% of China's gross domestic product, significantly below the global average of 56%, and half the level of the United States, which stands at 68%. This has been a major cause of China's prolonged low inflation, and at times, outright deflation. Prices of everyday goods and services in China have barely changed for decades. At first glance, that may seem like a positive thing, but such price stability drains energy from the economy. People delay purchases, and businesses lose incentives to invest. It creates a vicious cycle: high savings, weak consumption, and falling prices. And all of this slows down growth. While consumer inflation remains barely noticeable, one sector has already absorbed all the pressure. And where today we see sky-high valuations, the foundations are becoming increasingly fragile. China's massive debt might look like a disaster waiting to happen, but there is another side to the equation: assets. Unlike most Western countries, China owns an enormous amount of national wealth. This includes not only infrastructure and military equipment, but also land, public utilities, and most importantly, a vast portfolio of state-owned enterprises. According to the Chinese Academy of Social Sciences, China's state-owned assets may exceed $40 trillion, one of the highest levels of public net worth in the world. On paper, China appears stable, but its ability to respond to a potential crisis is severely limited. If the housing market begins to collapse and deflation turns into inflation, this complex system could start to crack. And in a system of this size, cracks can spread quickly. Despite their differences, both the United States and China now face the same economic paradox. They're both standing on the edge, but from opposite sides. The US lives under high spending, high inflation, and a private sector-driven economy that moves quickly, but often without consequences. China, on the other hand, controls everything, limits consumption, and tightly regulates capital flows, a formula that leads to stagnation. One country borrows openly, the other hides its obligations inside bureaucratic structures. But in both cases, the risks are rising. The United States is trying to rein in inflation and avoid falling into a debt trap. China, meanwhile, is battling deflation while trying not to crash its overheated housing market. And these are no longer just domestic issues. The entire world is feeling the impact. Together, the US and China account for more than 40% of global GDP. Their economic decisions influence interest rates in Europe and commodity prices in Africa. If either country faces a serious crisis, the consequences will be immediate and global. Capital flows, logistics, political alliances, everything could shift overnight. Two superpowers, two strategies, and both are balancing on the edge of a debt abyss. One relies on transparency and global trust, the other on control and silence. But as pressure builds, which of these approaches will hold and which one will crack? And if cracks do begin to appear, they won't stop at national borders. So the real question is, what happens to the world if both giants fall at the same time? To keep track of where global power, debt, and influence are really heading, subscribe to the channel and turn on notifications. See you in the next video.